Welcome to today's market analysis briefing. We are breaking down a massive structural shift that's going to hit the Vietnamese real estate market hard in 2026. Specifically, we're looking at the impending collapse of a trend that has absolutely dominated the last few years, the luxury micro apartment. Honestly, if you're an investor, this specific bubble bursting is going to catch highly leveraged players completely off guard. So, we're going to look directly at the data, the psychology, and the hidden costs driving this shift.
Okay, let's dive into this. Here is our roadmap for today's analysis. First, the 2026 breaking point. Then, the mistake of compressed space, followed by the operating cost shock. After that, we'll look at real profitability rates, and finally, lay out a robust restructuring strategy.
All right, Part 1. The Real Estate Breaking Point 2026 and the Macro Context of the Vietnamese Market. We're entering a phase reshaped by major legal reforms that took effect early this year, shifting the market away from strict administrative control to a real focus on efficient land resource exploitation.
To really grasp the scale of this shift, here's a number you need to consider: 200,000 to 300,000. That is the massive influx of new residential units expected to hit major cities in 2026 as stalled projects finally restart. This sudden supply surge is exposing a severe liquidity crisis for the luxury micro-apartment segment. We're talking about those tiny units aggressively marketed to successful young singles that are, quite frankly, now just sitting empty.
So why is this breaking point happening right now? Well, it boils down to extreme supply pricing. A quarter of new units are hitting primary prices of over 100 million VND per square meter. And in Hanoi and Ho Chi Minh City, a whopping 85% of new supply is sitting above 80 million VND. The cost of ownership has completely outpaced real income growth. In response, wealthy tenants are essentially staging a silent rebellion, flat out refusing to live in these cramped, supposedly hyper-efficient boxes.
Moving on to Part 2, the mistake of compressed space, focusing on the psychological and cultural clashes. Why does the small but luxurious model fundamentally fail here? It's because developers blindly imported the micro-living models of cities like Tokyo or Hong Kong, completely ignoring the psychological and cultural realities of local affluent tenants. For Vietnamese tenants, a home isn't just shelter. It's a vital tool for projecting social status, preserving what is culturally known as Taizian, or face. Squeezing a premium lifestyle into a sub-45 square meter box creates a massive cultural clash. Imagine trying to host business partners in a room where your bed is literally a foot away from the sofa. It strips away privacy and diminishes status, and honestly, no amount of expensive smart home tech or marble countertops can fix that. And this actually leads us to a real, measurable phenomenon known as the Psychological Depreciation Index. This is a formula that measures the actual neural stress caused by physical spatial limits, things like restricted area, low ceilings, lack of natural light, and constant urban noise. When an apartment dips below minimum thresholds, this index spikes exponentially. Your brain literally cannot recharge, leading to severe cabin fever. Beyond the psychology, you've got unavoidable daily mechanical frictions. In a micro-apartment, you're forced to use a mini-fridge, which completely derails a fresh food diet. Because there's no separated kitchen, cooking smells instantly permeate the whole space, and nobody wants their expensive suits smelling like last night's dinner, right? Plus, the thin drywall completely fails to block out your neighbors. Again, no amount of luxury finishing can fix these maddening functional bottlenecks. Which brings us to Part 3, the operating cost shock and financial deconstruction. We've established why tenants hate these spaces. Now let's look at the quantitative proof of why investors are bleeding money, focusing on the hidden financial traps devastating primary investors who relied on high leverage.
Now, what's incredibly important to understand here is how fixed costs are just entirely wiping out monthly rental cash flow. Management fees for these luxury micro units have absolutely skyrocketed, ranging up to a record-breaking 260,000 VND per square meter per month. Add in 10% VAT, maintenance fees, and parking, and the math just completely crumbles. To make matters worse, authorities have implemented strict regulations limiting short-term rentals like Airbnb, so investors are trapped with soaring costs and zero ability to pivot.
From a macro management perspective, Ho Chi Minh City maintains a strict firewall, a ban on new commercial apartments under 45 square meters. The city is trying to handle a population pushing 13 million on infrastructure that was originally planned for just 10 million. Banning high-density micro-apartments is a vital move to prevent catastrophic traffic and hospital overload. But for investors banking on that micro-apartment pipeline, this policy is effectively a kill switch.
Let's hit Part 4,
profitability rates, and real ROI across districts. It's time to look at a direct, data-backed comparison to prove exactly how suppressed returns really are right now.
This brilliantly illustrates the stark reality. In the core CBD, District 1, primary prices sit at a massive $7,000 to $8,000 per square meter. But with those management fees peaking at $260,000 VND, your actual rental yield drops below 4%. You are taking on massive leverage for a return that barely beats inflation. And even moving out to District 2, Bintang, District 7, or Thu Duc, the financial truth remains exactly the same. The traditional buy-to-rent model for tiny apartments is structurally broken.
So, how do we adapt? Part 5. Restructuring strategy and the flight to quality. Savvy investors are already pivoting, guiding their capital away from these high-friction micro-units and moving towards specialized high-yield asset classes that modern tenants actually demand.
Enter the co-living premium model. It's a real game changer. High-income young professionals still want urban convenience, of course, but they demand professional management. Instead of an isolated box, this model offers a highly optimized private sleeping module with absolute premium soundproofing, paired with expansive, luxurious communal living rooms, chef-grade dining areas, and co-working spaces. It essentially replaces isolation with high-end community.
And the numbers absolutely back this up. Professionally managed co-living premium models guarantee an incredibly stable 80% to 90% occupancy rate. Because tenants willingly pay for community and hassle-free management, this model actually increases revenue by 20 to 30% compared to a traditional self-managed unit. It's just a fundamentally superior use of space and capital.
Parallel to this, we're seeing a massive shift toward wellness and branded residences. By 2038, 1 in 5 Vietnamese will be over 60, driving huge demand for wellness properties, like the Tokyo Retreat, which literally pipes natural hot springs directly into the home. Simultaneously, an $8 billion branded residences market is just exploding. The ultra-rich are demanding operational excellence from international 5-star hotel brands. And you know what? For foreign investors and international management brands coming into Vietnam, this sector right now is a massive, lucrative opportunity. The undeniable proof? Both the aging wealthy and the ultra-rich entirely refuse compromised, shrunken spaces.
So the crucial point is, if you're an individual investor, you've got 2 clear restructuring paths. Path 1, rent and invest. Stop burying your capital into down payments for tiny, depreciating boxes. Rent a high-quality space to protect your lifestyle and invest your capital into highly liquid assets. Path 2, co-living premium conversion. If you own large, older properties in near-center districts, partner with professional operators to convert them into 7 to 10 en-suite premium rooms. This creates a highly defensive, high-yield asset.
Ultimately, the real estate market of 2026 demands discipline. The data clearly shows that compressed square meters that ignore mental health, cultural status, and financial reality are being mercilessly purged by high-end tenants. The shift to wellness and premium co-living isn't just some passing fad. It is a permanent, structural market correction. We've seen the risks, and we've mapped out the restructuring strategies. So I leave you with one absolutely critical question to ask yourself today. Is your investment portfolio ready for this purge?